commodities, everybody throws that name out there like soybeans and crude oil trade, in lockstep, right? That's not the way it works.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I am joined, as always, by the Brain Trust himself, Mr. Chase Taylor. And, it's your kind of day, man. It's Macro Monday. That's what we're going to start doing. Starting having a little bit of an extra focus on macroeconomic stuff on Mondays. Monday just seemed like a good day to do it. And you also got to take these kind of steps to try to spice up a Monday. So you know what I mean? Maybe you and I are the only guys that if you put macro in front of Monday, it would get us more excited.
I love Mondays.
You like Mondays, huh?
Yeah, I'm the opposite of Garfield.
Wow, just because the market
opens
again?
back up. Yeah, weekends are a bit of a bummer that way.
I do too, but
if they made 24-hour trading, I could not be more against that.
Yeah,
they've talked about that.
Oof,
because I need a break.
Yeah, man. No, it kind of all depends on what's going on in the markets. There have been several times in my career where you get to Saturday and you're just like, thank God, like 2 days without the markets open. But usually you're right. Like markets are, anytime like there's a holiday or whatever, I open my phone and you go to check the market and you're like, oh, that's right. It kind of feels like you're flying blind. You know what I mean? It's like you're at school without your lunch sack or something. It's just off. Anyway, so we'll get into some macro topics and kind of go down that list. But why don't you start off giving us a breakdown of the indexes? We're about a minute away from the close here, so it's going to be pretty close.
Well, good timing because we just closed.
There you go.
S&P up 0.14. The Q's up 0.35. Small caps up 0.69. Equal weight up 0.09. Mag 7 literally flat. All world ex-US up 0.09. The dollar up another 0.23%. Dollar's up close to 2% now from the bottom. Bitcoin up 0.5. Oil down 2%. Nat gas up about 4. Gold down 0.3. Silver down about 1.3. On yield land, on the 2-year, you're up 1. And on the 10-year, you're up about 1. About 2 basis points up on the 30-year. And then vol up about 1.5%. Some people seem like they've started to tap into buying some vol exposure.
Well, I don't want to jump out in front of it, but being able to buy vol going into August, considering what's on the docket, especially being able to buy it at somewhere between 15 to 20.
Yeah, I feel like at this point 19 is the new 15, kind of where we're at. So it feels like you're buying it expensive at 19, but like you say, given where we're going, maybe not.
Well, I think it all depends on how you look at the vol curve. Like where I'm sitting there going, yeah, I'd much rather be buying vol at 14 or 15, right? But in this context, at 19, it seems like a fire sale.
Yeah.
Do you know what I mean? Like right. When I look at the things that are boiling on the back burners, and if that's all I knew, and then you ask me, like, in 2 weeks, you're up against this. In 2 weeks, you're like, where do you think vol is? And I'd be like, my guess would probably be around 25. You know what I mean?
Yep. And
then you show me 19 and I'd be like, what? That's odd. And if something does go awry, well, when you look at the tariff, things are already going awry, right? We've already got bigger tariffs on certain players than we thought.
Barring getting a bunch of deals between now and August 1st, which feels low probability.
Yeah, I would think, and it'll be, it's going to be fascinating to watch this play out just because we haven't seen tariff action like this and trade action like this in decades. if ever, really.
Other than when we tried it for like a week in April.
Yeah.
That didn't go well.
No, we gave it the old college try, right? But no, my point is I think and we'll track this in real time, but we were just playing this game in a meeting that you and I just had, which is, okay, if that's the risk, what do we think is the best way to hedge that? Or what do we think will be most impacted by that? Obviously, you'd expect to see a sell-off in equities, but with vol where it's at, and then I turn around and look at where rates are where it's at, no predictions, do not trade on this. We're not right at this moment. But it seems to me that if you've got real concerns over that, it seems like kind of where I'm leaning right now is the best way to hedge that is long vol and short bonds, short the long end.
Yep, those are the two things that I think I favor the most as well. And that and just jettisoning some of your higher risk kind of, the stuff that moves more in your portfolio. So,
well, and other hedges, like some people might consider gold to be a hedge on that. I could totally see gold rallying. It wouldn't shock me to see gold sell off in that environment though, right?
That's the interesting thing. Like, obviously you go back to Liberation Day and we had the dollar get hit hard. Now, like, all these tariffs are at least verbally coming back on for August.
Right.
And the dollar's like bottoming out. And it's like, the one thing that would really mess everyone up, I think, is if the dollar did the opposite this time that it did last time. But you could say the same thing on maybe yields go flying down instead of up. Like, I'm trying to be careful not to just be like, well, what happened in April will happen this time.
Agreed. But and there are similarities, right? And I just kind of feel myself pulled further toward that side of saying, I think there's several different ways you could hedge it, right? I think you could make a really good argument that this might spark a big rally in the dollar.
Right.
That wouldn't shock me.
It's very oversold and starting to move higher. So
right. That wouldn't shock me. I just feel like the most bang for your buck. I think the most, and the reason why I say that is because if this tariff situation devolves worse or bigger numbers get thrown on or whatever, I think one of the most guaranteed one-off responses of other trading partners is to sell more bonds.
Right. And that's you open up a good important point there. So, like, not only is the market not at all caring about any of this tariff stuff yet, and I'm not saying I don't get that, because we still have like over 2 weeks until we get to August. So, but not only that, it's like I feel like definitely no one's wargaming for Europe or Japan or Korea or China, like doing more to push back, doing more to fight back on the tariff thing, whether that's through trade, whether it's through capital. Like Japan did a couple little nods to like, hey, remember we own a bunch of your treasuries, like wink wink.
Mm-hmm.
Now they after they did that, they kind of came out and like, oh no, don't worry about that. But it's like, okay, well, you put it out there for a reason. So for all we know, you get to August, we put them on, we're not kidding, a week goes by, and then Europe's like, cool, we're gonna take $1 trillion home, and here's your bonds, we don't want them anymore. Like, you never know. So the market not only isn't pricing in the tariffs, but it's also not pricing in any retaliation to the tariffs. And that stuff would be incredibly disruptive, potentially to bonds, to equities, you name it.
Yeah. I mean, especially at these valuations and these levels, it's a lot of, there's so many strands. And just when you think that this is a really complex picture, you look at something else, you're like, good golly, man, there's a lot of moving parts.
And to talk about that, like the cross currents, if you just removed the trade war, if we didn't have it, like everything looks honestly looks really good, other than housing and employment slowing. But like a lot of things look really good. You have fiscal stimulus. You have a lot of things that have been struggling lately starting to pick up. Like asset prices are at all-time highs. That feeds right back into the economy. Like a lot of things look good. The Fed would be cutting rates probably pretty aggressively by now if it weren't for the tariffs. So like it is a weird cross current thing. So to go back to, remember last time whenever they said just kidding and the market V-shape ripped all the way up here, like if we run this playbook again, let's say we get to September and the market's down 20%, 30% or whatever, like from the highs, we're having all the same problems. And they said, just kidding, this time for real. Like unless you completely broke something and created some nasty feedback loops, you better buy everything with both hands and feet again.
Yeah. No, I'm with you. I definitely think that they're individual. I mean, there's individual stocks and individual issues that I'd be concerned about that I think are up against it, especially when you look at how extended the valuations and prices are. But generally speaking, and here's the other part of it too, man, the passing of the big, beautiful bill, right? I mean, like those on the perma bear style or on the perma bear side of things, and those are, a lot of those same folks are, our debt's going to kill us, it's going to collapse us, all that kind of stuff, which of course in the long run I agree with, right? It's just so bizarre to me that they can just look, the only reason the market rallied for so long is our deficits kept going up and and now it's all coming apart. And you're like, deficits went up another $500 billion, man.
Yeah, I mean, the reason the markets have done so awesome the last 15 years is because we went so nuts with the debt and the deficits. I mean, and
0% interest rates and, all that kind of stuff. I mean, it's kind of hard. I mean, you created an environment where literally capital was the only thing that could go up. You know what I mean? Like, I mean, you didn't do anything to address labor, right? All you did was pump financial assets.
It's pretty good for margins and asset prices. So
yeah, it's yeah.
And speaking of the perma bears, like, they will decry the deficits and say like that's the only reason we're going up. It's like, cool, like they're going to get worse. You're buying everything, right? Like,
well, no, and that's the thing that people need to wake up to. And I know you and I have talked about it, which is you're like, guys, economies do not go away and collapse with their stock markets at zero.
Yeah, exactly.
They go away and collapse with their stock markets at record highs. It's called hyperinflation.
Right.
Right. And I understand how cavalier that sounds. I understand how belligerent that could sound to people, but I'm just looking around going, hey, this isn't some crackpot theory we're throwing out there. You've been watching this for 15 years, right? And more importantly, like we were talking about earlier, they've showed you their hands, meaning the one thing that isn't going to happen is this does not come apart in a deflationary collapse. It just isn't.
No.
And if they've got to completely degrade, nuke the dollar,
right,
and keep sending checks, they've showed you they'll do it.
If they have to shove the Fed into the basement of the Treasury and just do what they're told, then that's what we'll do.
And this brings up a point, and you and I have talked about, you've spoken on this many times, and I couldn't agree with you more, which is this why it's so important in this game that you've got to keep your political and long-term views in check. You know what I mean? And because the people saying it's unsustainable, they're right. On a long enough timeline, of course they're right. But that doesn't mean that sitting there and betting against it or sitting in cash, that's the other thing. It's like I'm short or I'm sitting in cash. Okay, so your argument is they're degrading our currency faster than we can do anything about it, and that's going to make you sit in cash?
Right. And what's interesting is some of the same people that will have that view often will have this like wow, I think the equity market has 10% more upside, but 40-50% downside. They always have like this cap on like, we can't really go up much more than this. I remember a very prominent person saying that at a conference, person I like a lot still, at a conference, I don't know, 10 years ago, like 10% more upside. And it's like, well, that was like 1,000% ago.
Yeah. And the whole reason why, I mean,
and for the same reason he says you can't own enough gold, it's for literally the same reason.
Yeah. Great example. I'll tell you how these markets could rally another 25% from here.
Easy. Right. Yeah.
Right. With the Qs and Mag 7 going up moderately over the same time. But like you and I talked about, look at all of these things. I mean, and this is the crazy part about this market. As much of a guy is, I sit there and talk about it being so extended on valuation. It's historically extended on so many different levels. At the same time, it's just not all, we were sitting around, we bought Snap, and I'm not advising anybody to go out and buy Snap. It was a small position. I won't even tell you if we still hold it or not. No recommendations. But we bought Snap, a company that's still growing at 13% a year at 4.5 times revenue, at a fraction of where it had been previously.
Big time fraction.
Yeah. So and then you watch crypto breaking out again, you want a narrative that talks to you about how this market goes up 25% here from here in a really quick hurry. All the stuff from 2021 reflates. A lot of it's still bouncing off bottom. Right. And they go, oh, it's already expensive. It's already too expensive. And you go, once again, man, where have you been? Where have you been? Point is it's nowhere near as nosebleed expensive as it was. And if you haven't been paying attention, this market does not need a lot of coaxing to run ridiculous things significantly higher. And when you look at a reflation of all those kinds of things, like where would the NASDAQ be? Like if everything else held where it was today, and all of a sudden we looked at, like, let's say 6 months from now, Mag 7 is basically trolling right around where it is right now. But let's say ARK is back up to 140, 150. That's a market that's gone way up.
Yep.
Even without Mag 7 leading the charge.
Yep.
Right.
And that's kind of really kind of what we've been doing here lately. So
yeah. Now I think there's a misread in there. Yeah. My personal opinions, I think a lot of people are looking at the wrong stuff to buy. But you know, again, when you get into governments being this active and this involved monetarily, fiscally, all these kinds of things, you know, man, I am as much of a financial historian as you are. Love it. I believe that history is prologue, right? Like, having said that, when you've got governments at this stage that, like I said, are so involved fiscally and monetarily, don't pull up your ancient charts of the markets and expect them to behave in periods like,
well, to your point, like past this prologue, go read When Money Dies about Weimar Germany. I mean, the way to survive was to own assets.
Yeah. And I don't see now, like I said, I think a lot of people are buying really ridiculous, stupid assets right now.
Sure.
And speaking of that, I think crypto is a good one to bring up because I'm not calling it a stupid asset. I've gotten in trouble with some of our own clients. And I'm like, guys, we own millions of dollars of Bitcoin. I'm not anti-Bitcoin at all. And I gave a big talk about that last week, so we don't need to revisit that. That being said, one of the best charts I'm seeing out there is Bitcoin. I mean,
yeah, it's at a new high. So.
Right. And then, and just the way it did it, right? That classic pullback 25, 30% from the high, you know, bump up, grind higher, play with that all-time high. Yeah. I mean, I'm not a hip deep Bitcoin investor, maxi, anything like that. I will say, you know, where was that previous all-time high? Was it 113? Was that the previous spot?
Something like that. Yeah.
Yeah. I mean, again, if a guy there's a fairly attractive trade out there, right? Load up long Bitcoin. You got that stop just, you know, what, 4.5% below you.
Yeah. And we faded some today on it. So you might be able to go kind of almost retest that area, and then you can keep a super type stop. Yeah. Which is kind of the name of the game.
Yeah. It always cracks me up. It doesn't crack me up. It's probably just a lack of experience. But when people are like, you know, when they're asking you sizings on positions and you look at them and you're like, well, I got to see the chart. You know what I'm saying?
100%. Like
it. And I'm not very technical, but even I've learned to realize, like, even if I like this thing fundamentally, I got to let the chart tell me a lot, you know, because a lot of it is how far away from a breakout, how far away from a breakdown, you know.
That's why I struggle to trade things that are on a stick. It's like, because I know if I look at where I need to put my stop, it's so far that it just makes it a dumb trade. And whereas you could have the same thing where it could be something I don't even like, but if I can keep a really tight stop, then that's a good trade to me.
Oh yeah, I mean,
start with the risk and you work 100%. Forward towards where the reward might be.
100%. The other one too, man, and this is just random. I'm just throwing it in there, but I was just thinking about, you know, we sit around and get around. You know, we had your buddy up here, Jason, the other last week, and it's just fun to sit around and talk to other money managers, get other perspectives, you know, get other people's takes on things, and chopping it up, sharing notes, all that kind of stuff. I think one of the toughest things that I have, or that I personally struggle with, is, and I think it's a challenge for everybody. It is that sizing, right? How big you have those positions. What is responsible? You know, what isn't? You know, like we were discussing the sizing in our commodity positions right now. And I'm not going to say it because I don't want to give anybody just whatever.
It's more than the benchmark.
Yeah, it's well north of the benchmark. We were going back and forth. Like if that goes sideways, it's not going to look very smart.
No.
And it's going to be like, hey, that's some really heavy exposure. What were you doing? The tough part about it, though, is you look at the things that we own, you look where they're at cyclically speaking, you look where they're valued, and it's not so much that I want to be that overweight commodities. It's just,
and it's like a dozen different commodities with their own unique,
yeah, right. Yeah, right. That's the other thing is commodities. Everybody throws that name out there like soybeans and crude oil trade, in lockstep, right? That's not the way it works. But yeah, the size.
Actually, they both just go down. So maybe.
yeah. But no, they just, when you look at the action that we're seeing in metals, right? When you're looking at, a quasi breakdown or somewhat of a restructuring of global trade, right? Globalism, generally speaking. And then you turn and you look at all of these things that are going to be intimately impacted on them. And virtually all of them will probably be impacted on the higher side of things. And then, like I said, then you go look at the underlying valuations of these things. It's very hard to be a fundamentally minded investor in this environment and not be overweight a lot of that stuff.
Yeah. And plus, to keep it macro Monday, I mean, if you think about the fact that basically the entire globe is doing fiscal stimulus, man, that just makes it hard. And the dollar's in a bear market. Like, just those two things make it really hard to not be, pretty heavy in commodities. And something I mentioned in my letter this week, and we talked about in our meeting this morning, one of the worst ETFs you could have owned for the last decade is the XME, the metals and mining ETF.
Yeah.
And that thing is breaking out against the S&P, which most sectors aren't right now. Because if it's not tech, it's probably not doing that good, right? So if you look at energy, getting killed by the S&P. But if you look at XME, like it is starting to break out from like a 2-3 year downtrend line. It's gone straight down and based for a decade. So like it's just interesting to see. And this guy, he's just full of like dogs, like, just steel and coal and aluminum. And just like, if you look at the holdings, you're like, I don't want to own any of this stuff. But then you look at the ETF, the whole thing versus the S&P, and you're like, okay, like real stuff is like picking up in a meaningful way. Now it doesn't mean it won't just be a quick, prairie dog, as Kevin would say, but it's notable to me that, because I like to flip through every month and look at every sector versus the S&P on that ratio chart. And that's when I hit XME this month, I was like, whoa, didn't realize that.
Well, the other thing too, and again, I'm going to sound like I'm kind of bidding against myself here, but I think that you have to be more careful in this environment than any other environment that I've ever navigated, certainly, as it relates to applying historical data. Meaning I have seen 100%. More historical data break in this cycle than, and
for good reason. The real life stuff is really different.
Really changed.
20,
really
30, 40, 50, even 10 years ago.
Yeah. You know what would be fun? It would just be, it'd be interesting to me on a personal level. We should go through at some point for one of these shows and literally make a list of every single one of these long held things that have been broken through the cycle.
I could easily do that because in 2022, I threw them at everyone ad nauseum for all the reasons we're going to have a recession.
Yep.
So I have a laundry list of them because at the time I was like, look, this is an open shut case. Here's like 25 charts that show you we're going to have a recession. Well,
and look, it was the argument. I was a big student and fan of the yield curve. Okay. Perfect example. Okay. But I remember having this conclusion probably around 16 or 17. Maybe it was earlier than that, but it was one of these things where I was really convinced. I'm like, look, the thing's never been wrong, right? I think it was the 10s and the 3s and 10s.
You go 3 month 10-year. Yep.
3 month 10-year. Yeah. 3s and 10s. So that was the one I was following. And then I had this realization where I went, wait a second. The Federal Reserve, and I think at that time only owned like $2.5 trillion worth of bonds or something like that, which was almost a tripling from their holdings as of 08, going into 08. And you look at all the QE, you look at all these different things, and then you step back and go, why would I expect the yield curve to be an indicator like it's been in the past when it's not? The yield curve is effectively where that central bank wants it.
Right. It's true.
Right. And
at least while they're actively doing QE and everything.
Well, yeah. And everybody's like, well, they don't control. I'd be like, well, what about Operation Twist? That was all about them molding the yield curve to fit the
right
trajectory.
Now, jamming us with 2 years under instead of, 10, 20, 30 year.
Right. And so when you see all these things going on, you sit there and go, look, the yield curve as it laid out used to have a ton of data in it, because really what it was telling you is it was telling you where investor demand is.
Yep.
Right. The yield curve doesn't do that anymore. I mean, it does to a certain degree, but I don't think anybody would make an argument that central banks aren't significantly more weighty in determining, for most economies. I realize that some central banks have lost control, but it and that long held one that made all the sense in the world, why it was such a great indicator, it broke.
And same with you can look at like manufacturing, manufacturing ISM, which has been just in the dumps basically since COVID. And historically, if you had a bad ISM, bad manufacturing in general, like you're having a recession. But if you look at how much of the economy was manufacturing 20, 30, 40, 50, 60 years ago, it went from most of it to a lot of it to now it's like who cares? Like you can shut down half the steel plants or whatever. And like, as long as you're buying tech stuff and stocks are up, then everything's going to be fine.
Yeah.
So there's a lot of stuff tied to like the industrial business cycle that you can make indicators out of. So versus like the actual leading indicator index that we all like quote, it was so heavily skewed towards manufacturing that the smart people were smart enough to ignore it like 22, 23 and be like, yeah, no, it's not going to work that way anymore. If the tech guys are doing okay, then who cares?
Yeah.
Like that was the right call.
Yeah. And it's frustrating to say it, but
because I was on the wrong end of that for sure.
Well, yeah, but at
least I learned, right?
Yeah. Well, at least you learned. But the other thing, that I think people forget, and again, forgetting about the dynamics that we're living in, is we're living in a period of time where 7 companies in the S&P 500 make up like 30% of all profits or something like that.
And back then, you obviously cyclical swings hit manufacturing. Like,
yes,
it is very cyclical. Now, that just doesn't work that way. Now what's cyclical is housing and stocks. So like if stocks go down, sure, you're gonna have a cycle. If housing gets hit hard enough, yeah, you'll have a cycle. But other than that, you're just not. And what we've left out too, obviously, and what we talk about all the time, those deficit, like all those prior instances where it's like, oh, the yield curve or the leading indicators, the ISM or whatever you want to, cook up is like, cool, we had a 1% deficit back then. Now it's 7, like it's not the same. And speaking of that, something I read this weekend that it put the deficit into perspective from like how stimulative it is now point of view. We all know we're spending, well over $1 trillion now on interest on the debt, right? If you look at interest on the debt, it takes up 20% of tax receipts. So you take in the tax receipts and then you take a fifth of that and you turn around and you give it back to people in interest income. Like that is just mind-bogglingly stimulative for the private sector. Obviously, it's super uncool for the government's balance sheet, but for the private balance sheet, like that is, you've built a perpetual motion machine essentially.
Yeah, I mean, not even
a fifth, and it's going to get worse.
I'm trying to look up what the total profits are, like what total profit on the S&P 500 was last year.
Like in dollar terms?
Yeah.
I'll find it.
I bet.
Talk about something.
I bet you can find it.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Well, Joe, just an interesting analogy I want to make. I mean, I'm assuming the number is going to be fairly impressive.
Yeah.
But no, it's I think one of the things that people have a tough time with, and I know I have, is that it's not different this time, right?
Yeah.
It's that age-old deal where the hallmark of walking into a problem was whenever the justification was, but it's different this time. Okay, It really is.
A lot of things are very different.
They're very different. And when I say that, I'm not making an analysis or I'm not pushing why any individual stock can keep going up forever. And I'm not saying that means that Bitcoin's going to 10 million or anything like that. But the reason I say that it's different this time is you need to know what environment you're in and what dominates it. And when governments are running deficits that are 7% the size of your entire economy, it doesn't make a lot of sense to go back and look at indicators that worked when it was 1 or 2%.
Right.
Especially when that deficit is going up. Do you have that number?
It's about 1.9 trillion.
Okay, so 1.9 trillion. So think about that. The increase in our deficit this year alone is 25% of all of the profit in the S&P 500 last year. But that is not an unsubstantial sum.
It's hard for S&P profits to not go up with that.
Right.
And I've seen that charted to show like the deficit level and then S&P profits, and it's a relationship for sure.
Yeah, and this is my point to the holdouts out there. Is that appropriate? No, it's obscene. These are bad things that are going to cause significant pain and problems down the stretch. But when we're in this environment, when you're looking at currency degradation, right, and you're looking at the only way you protect yourself from that is growing a bigger stack.
Yeah.
Right. And so I just think people need to be, yes, are there reasons? God, there's so many things to be freaked out about right now, right? I mean, you know, we've talked about it, looking at the pile of risk and record valuation. Yes, there's all kinds of massive risks, but we've got to weight those risks. And I just think when you're in this environment, I always play that game 10 years from now, looking back on this, how will I analyze this, right? Like, what do I think we'll glean from this period of time or this decision or whatever? But I think 10 years from now, you look back and you're going to look at, I think probably one of the number one comments is you were bearish asset prices.
Yeah, it's true.
You know what I'm saying?
Yeah.
And I think that could be even levied at me at times. There's been
Sure.
times over the cycle where I've been far too conservative based off of prior experience, based off of historical records and the way things have worked. And haven't paid enough attention to what's really driving things. And
that's what we've talked about too. Like if you map stuff like the S&P onto money supply, it's not even impressive. And something I give Raoul Pal credit for was like, he basically just mapped everything against, monetization, devaluation, and realized like, oh, most stuff isn't going up at all, to include the S&P actually. Now NASDAQ can keep its head above water. Gold can stay about flat. And Bitcoin to this point in its existence, partially because it's new, has dramatically outperformed everything. So he's glommed onto that, which I think for a while is definitely fine. It will work, but you get into this point where it's like, all right, look, it's just one giant liquidity game. They have to do that for a while.
Mm-hmm.
Like, it's kind of obvious.
Mm-hmm.
They're trapped into it. So it's just buy the things that liquidity makes go up because you're going to get it. And, Luke Groman's basically just give me some gold and Bitcoin and maybe a few specific sector stocks like industrials or whatever because of policy. Like, I'm good. And yeah, 10 years from now, yeah, if you were in cash or something similar, like you're just going to look back and be like, oh man, what happened to all my purchasing power?
yeah. And you're like, well,
eventually, it changes, but eventually is after inflation hits hard, brings the debt to GDP down, gets so bad that the public is willing to be like, you know what? Like, I will take that disgusting medicine as long as you make this inflation go away.
Well, here's another reason. I think this is a practical reason to help people understand kind of the dynamic. And I can't prove this, but I'm pretty sure it pencils out. I think one of the reasons that assets, and specifically now financial assets, just because they're more accessible than they've ever been, right? Everybody and their mother can jump on their phone and start trading stocks. So that definitely plays a role. But if you think about it, it makes perfect sense that assets and financial assets and things like that are the biggest winner from government largesse, because when you've got like everything being held normal, right? Let's say take central banks out of it and let's just look at a basic economy functioning. When that economy is increasing profits by, let's say, 10, 15% a year, right? you're freeing up more capital inside of that economy. And a lot of that capital is probably going to be invested in things that help creating the 10 to 15% profits.
Yep.
Right. But when that excess capital is coming straight out of the treasury, right, you're not actually improving.
You dull the signals.
You totally dull the signals. You're also not improving the investment outlook of any particular true investment, meaning just because the government increases its spending doesn't mean that I necessarily want to go build a new factory somewhere. Right. And the reason why is it's not liquid. Right. There's all these kinds of reasons. It's a significant investment and there's inherent risk there. Right. Well, think about it. Buying a bunch of stock is like dating compared to building, a new factory, which is like getting married. Right. And so when you're in this uncertain environment that's being driven by government largesse and government spending, not just typical economic activity, you're not nearly as incentivized to invest that capital in a more traditional way.
Right.
Because
it's funny you say this. I used to explain the Austrian business cycle theory using an example of if you owned a restaurant and the circus came to town and you just started booming because the circus was in town. So then you expand, and you borrow a bunch of money, you build a new wing on your restaurant, but then the circus leaves town and you're like, oh, and then you blow up. That's basically the business cycle. But in that example, it's exactly what you're saying, where like if it's just the government throwing money at it, it's different than like a real organic demand source pops up.
Right.
It's harder to trust.
Yep.
So it's weird how that works. And we've seen like in this last 10, 15 years, asset prices have been amazing. But then if you look at the real hardcore like CapEx, if the government didn't point a liquidity gun at a sector like semiconductors, you haven't built that much stuff. You haven't had a lot of CapEx. Now the big tech guys have been able to do it, but they can self-fund it. They don't need to borrow for it.
Yeah.
And they've had obvious like real use cases of giant productivity leaps and stuff. But across the broader economy, it's almost like people actually understand, and the banks even understand, because credit growth's not been impressive over this period of time. It's like everyone kind of gets the joke of like it's a circus. Circuses leave. It's interesting in that way. It's hard to make it a circus and make everyone think that it's like the Cirque du Soleil. It's going to operate here forever.
Yeah, and a great analogy I think of that is, how many investors out there right now would be all for, pooling, 5 or 7 of us together and going buying a $5 million piece of land somewhere to develop. Not saying that couldn't be a great investment, but for a lot of reasons, a little trepidatious.
Yeah.
Right. At the same time, flip around, look at the stock market. You're like, well, I'm just going to put a stop right here, and
I can get out as soon as I see the circus pick up a spike out of the tent. Right?
100%. Yeah.
And I never thought of it this way. It's kind of fun, but in a way that almost helps explain financial nihilism is like if everyone, even if they don't realize they realize it's the circus in town and that they better not trust it. So give me something with a bunch of liquidity I can punch out of at least, versus like the amount of people putting a bunch of sweat equity and real capital on the line to do something entrepreneurial has been, that's been lagging. It's been missing compared to, plus the returns. Like, why do that if I can just buy the, 2X Qs and retire, young?
Oh yeah. I mean, look, even for the guy that's patting himself on the back right now for getting into that, multifamily housing deal back in 2013 that's ended up having a 7.5% IRR and all that kind of stuff. Good for you. Happy for you. Go compare that to the Qs.
Right. And if the circus leaves town, like being in the liquid thing was going to be better.
Oh,
even though like, that's all going to be a giant problem too, of course. But like, I don't know. It's just a weird framework.
It is a really weird framework. And what I think that this will yield, and I mean, it already has at certain points, but what I assume this would yield is probably some pretty amazing opportunities to buy some more liquid assets at some point. Just because, if you look at it, liquidity, even if people don't realize it, liquidity is becoming a bigger and bigger proxy, even for people that, like I said, that don't realize it. You can sit there and be like, why are you why are you trading that? And they'll give you an answer and you're like, oh, it's because of liquidity. Meaning they're like, no, I believe in it. I'm like, yeah, but the way it's the in and out function. You're gambling.
Right.
And I'm not saying that, look, it's one of the advantages of stocks, right? It's one of the reasons that stocks trade at a premium.
I don't have any private investments is the thought of locking it up freaks me out.
Well, especially in this environment, right? Like I remember, to be fair, I was broke and my house was deeply underwater too. So at the time I didn't have any way to do it. But I remember looking around at 2010 and going, God, I wish I could buy a slug of houses right now.
Yep. Did okay.
Yeah. But you know what I mean, though? It wasn't like the premonition that if you asked me where housing prices are, I wouldn't have thought they'd be as high as they are now.
I don't think anyone would.
But usually those opportunities are marked by very low prices.
Yeah.
Right. And that's
forced selling.
And that is the conundrum today.
And we're kind of starting to get that in privates because of the small scale, but like where, especially the big endowments and stuff that were sovereign wealth funds, they've taken off way too big of bites of private, and now they need to move. And yeah, you can sell it, but like that liquidity is nasty. Like that's not a fun ride.
I'm trying to think in a macro Monday. It's a good one you bring up. I'm trying to think of an analogy about private equity right now. And I know that there's an amazing analogy out there that's really, really funny that looking, I feel like it's almost like the financial version of like the Ashley Madison hack. Remember when that Ashley Madison's that website that
I vaguely remember that.
Married people hook up with other married people, that kind of thing. And then somebody hacked their website and all those names got released.
Oh, yeah.
And there was kind of like this at the time, you're hearing these stories popping up of so-and-so's name getting out. And you're kind of looking around going, what's next, right? What's behind the next corner? And this situation kind of feels similar to me in that way. Private equity. Because it's a really interesting scenario because nobody heavily invested in it right now has any interest in unwinding it. Yet they all need the liquidity though.
Right. Some people have to because of like, some regulatory changes with the way we're treating that money. So, and if you don't mark to market often and you need to get out, well, you're about to get marked to market.
Right.
And that's where like the Ashley Madison thing comes out. It's like, well, you're about to find out where some things are worth.
You're about to find out. The tide's about to go out real quick.
Is it worth what you can sell it for? And you don't know.
Well, and like you look at some of these endowments, I want to say like Harvard's endowment.
Some are 40-50% private.
Which is just insanity.
Yeah, that's.
I mean, in an endowment portfolio like that, I'm on an investment committee for a non-paid investment, purely advisory. I don't control any of the underlying investments for a small college here. And I can tell you, I would never push for more than a 12 to 15% position in private equity. And if I was going to go that large in private equity, it would have to be because price dictated it.
Right. And it was great whenever David Swinson pioneered it for Yale back 30 years ago because no one else was doing it.
Because nobody was doing it. Right.
So it was priced phenomenally. But now everyone's doing it. So the price isn't very good. And like, how's that not? Obvious people I don't know. To me, the only good private equity, well, I shouldn't say only. The best private equity stuff are the really great operators that actually add value, that will go buy, like roll up mom pop, blue collar stuff, and then literally make it way better.
Yeah.
And make it like a small regional like thing or whatever. Like you can make a lot of money doing that. And with really good businesses that keep really high service levels and stuff, not by just, squeezing all the money out and then moving on, but people that will want to operate them for forever.
Yeah. The reason those guys and this is why this happens, I will never. One of the biggest questions I'll get from people, family, friends, all the time is they'll look at me and they'll go, "Hey, so on something like the Harvard Endowment Fund, $50 billion, got to believe stupid people aren't running that." And you're like, yeah, no, they're not stupid. They're like, but why do those people always make those kinds of decisions? And I looked at them and I go, I don't know. But here, if you want to know why they have 50% in private equity, I'll tell you why. It's because it's stock market returns with fixed income volatility.
Yeah, and everyone's doing it. I think the mimetic part is underrated. If you go to a cocktail party or whatever, like all your boys are doing it too. So what are you going to do? You're going to do that.
It just irritates me though when those things, like, how long people have been saying that for years. This whole private equity write-up. Oh, it's stock market returns, fixed income volatility. It literally, it's more irritating than when I hear somebody quoting the Dow for performance of the market. Just because I look at them and I'm like, What does that have? That is impossible. What you just said. That's ridiculous. That is a ridiculous statement.
It's just infrequently marked.
It's just infrequently marked. And you can't, like, that doesn't work. And people are like, what do you mean? And I'm like, the volatility is what creates the returns. You can't have one without the other. It doesn't work that way.
Yeah. And if you have hardcore perpetual capital, like if you worked for like to me, less so for the schools, like they got bills to pay. But maybe if you were some giant charity kind of endowment where it was like long-term, like, look, just pull out blank percent every year and go put it to these causes.
Yeah.
And use hardcore long-term thinking.
Yeah.
Then sure. But man, if you got bills to pay that matter, like they obviously do for these colleges.
Well, the other thing that's tough about private equity is
it's sort of like duration risk. It's just, you better hope you sell at the right part of that duration's lifetime.
Well, and and you're looking at a more limited universe, right, of names. So by definition, the more popular that space gets, the lower the quality businesses that are getting taken out are, and the higher price you're paying for.
Yeah, and that's definitely bears out, and it bears out in the data for sure.
Yeah, it's one of those things that's been frustrating. There's been plenty that I've gotten wrong but there have been some of those ones that are frustrating where on the face of it, in the beginning of this, you all went, yeah, that's nonsense. I don't understand why anybody's buying into that. And that one's played out much the same way. Anyway, we've gone over. Anything else you want to squeeze in here that we left out?
Two real quick things. Tomorrow's morning CPI, my gut suggests they're going to come in a little light again, a little low.
Okay.
So I think that will create a short-term, I think, kind of fake move, because I still think the inflation is coming because of the tariffs. I just don't think it's here yet. So I would expect, rate cut possibilities to go flying higher, and the market will probably appreciate it. The other thing was potential Russian sanctions. President Trump gave Putin essentially 50 days to, ceasefire or something that looks like it, or we might do secondary sanctions on other countries that buy their stuff, which would make most commodities go way up in price. Just interesting. Do I think it comes to that? Probably not. Do I think Putin figures out a way to make it look like he's doing it again and gets an extension for another year or whatever? Probably. But let's say the high impact, low probability thing happens, and we really do. We're like, whatever. We'll eat the pain. We'll deal with $100 oil. That would be a macro like shockwave come early fall. Just something to put a pin in on the calendar for September to maybe that gets interesting.
A lot of things that could get interesting really quick, man. Like I said, it's pretty.
And it sounds like we're going to give the Ukrainians some Patriots and stuff. So like the war was actually going to get interesting as well.
Wow. Yeah, it's a complicated board. That's for sure. Anyway, all right, guys, that does it for us today. As always, if you want to follow us, go to knowyourriskpodcast.com. On all the social medias, InstaFace, that's our favorite, of course. YouTube, just search Know Your Risk Podcast. Pretty easy to find. Until tomorrow, folks, have a wonderful evening. We'll see you then. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.